Welcome. You are listening to Purpose Driven Wealth, the podcast for empowered investors. If you're an investor who is tired of playing the Wall Street casino, stay tuned. On this show, we bring on industry experts to discuss leading strategies to help you make empowered decisions with your hard-earned capital. And now, here is your host, Mo Bina.
Welcome to Purpose Driven Wealth. I'm your host, Mo Bina. Today on the show, we have Kaaren Hall. Kaaren is the founder of uDirect IRA Services. Through uDirect IRA, she has guided tens of thousands of investors through the process of diversifying their investments using self-directed IRAs. And she has close to $1 billion under management. Kaaren, welcome to the show.
Thanks, Mo. Good to see you.
Yeah, same here. Good to see you again. Yeah. Can you please start us off by kind of talking more about your background and why you founded uDirect?
You don't grow up hoping to create a self-directed IRA company. That it's not. There's a path. And my path started with being a radio announcer for 17 years, right? And then making the logical transition into real estate, like so many. You do one thing and then you say, yeah, no, I think I'm going to make some money, so I think I'll get in real estate. So I started off by managing apartment buildings in Seattle. I was still in my 20s, and I got a real estate license at that time. And from then, long story short, just got into mortgage loan servicing and serviced mortgages for about 8 years. And then I got into origination. And by this time, I'd moved to California. That was a few years ago. And did loan origination until we couldn't anymore in the Great Recession. So in 2007, I got a job with a self-directed IRA company, and I worked for them for a couple of years. And then I launched my own company. And that was, I just totally bootstrapped it from just zero, and from zero to where we are today. It's like a 14-year trip, and it's been a not easy ride, but it's been a great ride, and a lot of happiness along the way, and happy customers and happy employees and all that.
Oh, that's amazing to hear. Amazing to hear. Yeah. Let's start off with the basics. So what is a self-directed IRA?
Right. And that's confusing to people, because like, what's an IRA? So an IRA is a bucket that holds retirement money, right? So these things were created in 1975. It was the ERISA law that Gerald Ford signed into effect. So it created the IRA, and it's always been self-directable. But what happened is that financial advisors, Wall Street, kind of took over that product or that service, that IRA thing. And we began to think of it as only being stock market based, like, oh, you've got it in mutual funds or you own stocks, but you've always been able to invest outside of Wall Street into alternative assets. So a self-directed IRA is a regular IRA, just like any other IRA, that can and is allowed to invest in alternative assets like private equity and real estate, performing and non-performing debt, multifamily, everything, self-storage and mobile home parks and precious metals, all these things.
Yeah. So how do these type of retirement accounts or how does a self-directed IRA differ from other types of retirement accounts that are out there?
Yeah, it's exactly the same except one thing, and that's the asset class that the IRAs hold. Everything else is the same. The way the money comes in as far as contribution limits, and the money goes out the same way and is taxed the same way. So everything is exactly the same because it's an IRA, just like the other IRAs. It just holds a different asset class.
Gotcha. And how have these types of accounts grown over the years with investors?
Yeah, that's something that we've really seen a lot of lately. I'd say over the past year and a half, that we had a lot of people in, 2009 is when I started the company. So around that time, people were buying real estate on tape, buying houses on tape. That was the day. So you want to buy low, sell high. I mean, that's the absolute basic of investing. So people did, they bought low, pennies on the dollar real estate, and then have been selling it at the peak. So we're seeing people who have put real estate in their IRAs, their Roth, traditional SEPs, simples, self-directed solo 401ks, all these kinds of accounts. And then now they're reaping the benefit of the long-term hold and all that rental income, and they're enjoying that appreciation.
And within these types of accounts, um, what type of assets can you essentially hold? Or maybe it's easier to describe it in terms of what you cannot invest in.
It really is. Yeah, you're right. That's a really good point. The IRS, when they created IRAs, said that these IRAs can hold anything except life insurance contracts and collectibles. Like, that's it. Now that's what the IRS says, but you may find that the custodian considers some assets not to be what they call administratively feasible. So a custodian can make a business decision about what assets they will and won't hold. For example, you could invest in a racehorse in your self-directed IRA. That is definitely an alternative asset, but that's an asset we choose not to custody. So for us, racehorses would not be an asset that we would custody. We would call it not administratively feasible. Now you could find someone, I'm sure, out there who would do it, but that's not an asset class we choose, make a business decision to custody.
Is there a particular reason with regards to just the example of the racehorse, why you would not want an investor to hold that within their account?
Well, it's the complexity of the asset. I mean, but I think ultimately it comes down to the ability to evaluate an asset. When I think valuations, and it's just a tricky asset as opposed to an asset that's known like real estate. And so that's just a risk that we don't need to take. And what if somebody puts a racehorse in their self-directed IRA and they pass away, and then nobody claims the horse,
Mhm.
and who's going to take care of that horse? Is the trust company going to own the horse? Then it gets tricky. So it's a living creature, and that's an asset we choose not to custody.
Yeah, I guess that's I see your point with the complexities, right? It is technically a living animal, like, and putting something like that into an account could come with it could come with some snags, especially down the road. So
Yeah, the IRA isn't going to come feed it.
that's right. Who's going to provide water and hay, right?
Yeah, they really love that stuff too.
Are there any other like assets or investments that maybe custodians may not maybe
Hmm.
frown upon or not want the investors to kind of hold within their account?
Maybe so. Like one asset class. Did you know that tickets, like when you buy a ticket, did you know that that's real estate?
You mean like a
It's
movie
like,
ticket or like a
yeah, any
ticket for
ticket,
the
like to a ball
performance?
game or anything, it's real estate. And
Wow.
so things like Super Bowl tickets are assets, but that's an asset class that we choose not to hold tickets as assets, even though they're real estate, again, because of just the flexibility and the complexity of the ticket. So what you've done is you've leased the right to sit in this space, right? And so you've leased that seat, and it's real estate. So it is it's a real estate transaction. So that is an asset class, and you'll find, you'll pay more probably to have that custody, but you could have, like, Super Bowl tickets, for example. If your IRA purchased them, you could have that in your IRA,
Wow, I did not even know that. Never heard that before.
right?
You had mentioned the valuation aspect. Is that something that comes along with having assets within an account?
It's huge. It's really huge. Like if you have something in the stock market and someone wants to know, hey, what is this worth? Well, it's super easy. You just go online and you can see the value in a minute. When it's an alternative asset, that value is not really apparent, right? And so you have to have a valuation. And so if you are about to engage in a taxable event like converting your pre-tax dollars to Roth, and that's taxable, or you want to take a withdrawal of the asset, then you have to have a third-party valuation from an appraiser for real estate or a valuator. There are asset valuators out there for all assets. You have to give a valuation because we're not fiduciaries and we can't provide a value. And so we need a third-party evaluator to come and tell us the value so that we can express that to the IRS and then issue a 1099 in that amount. But we can't decide what the value is.
I see. And these valuations have to be done annually, correct?
They do, but again, it's really, when push comes to shove, the formal third party, pay a couple $100 or several $100 for evaluation only happens when a taxable event's going to occur, like a withdrawal or a Roth conversion, a conversion to Roth.
Oh, okay. So then typically after unless you're dealing with those types of events, then there isn't there is not an evaluation, or sorry, valuation that needs to be done.
Well, right. So what I'm saying is every year you need to provide a value to your custodian. And you can do that by going on the internet and finding a value, like a broker opinion of value, something informal.
Okay.
So you do need to provide a value annually, but when it has to really get formal is when there's a taxable event.
I see. So it's like, for example, someone asks you the value of your home, you just go look on Zillow and say, well, my home's about,
Yeah. Do you look on Zillow for the value of your home? Do you really? Come on, you don't look there.
I have looked it up, but that's different than having a full-on licensed appraiser go out and generate an appraisal report for your home.
It's very different.
Yeah.
Yes.
So
Very
doing
different.
that type of informal research using a Zillow to estimate the value of your home is
Automated
fine.
valuation model. Yeah, AVM, right.
Gotcha.
That you could do that in a pinch, it could, because you need to provide some value to the IRS annually.
I see. And then as far as like holding, like, let's say crypto or Bitcoin, these types of investments have, really garnered a lot of attention in the last few years and have been growing with investors. Do you prohibit the holding of these types of assets within like these types of accounts?
We don't. We allow it and we offer it on our platform. We offer access to Coinbase on our platform. Now, if you want to invest in cryptocurrency, I mean, you got to know it's the Wild West, and there's a lot of it's very risky. But if you want to take that risk, you can. You can with your IRA. Same thing with precious metals. You can go on our business platform and invest in precious metals. These are things that have a market price. So it's not that, we're not recommending it or saying that's what you should do. But if you want to, it's there. And it's pretty much the whole market will bear a certain price. So it's there. And also when it comes to metals valuation, we know what the spot price is of silver and gold and palladium and platinum and so forth. So those are easier to value assets.
Yeah. And are there any types of misconceptions that you run across that people have with regards to self-directed IRA accounts?
Right. I think the biggest misconception with self-directed IRA accounts is that their IRA is a down payment on real estate. So, because when you and I are buying a house, right, we're going to put a down payment, we're going to come in with the rest. And if it's, a non-owner occupied property, maybe we're going to get investors and we're going to do all this, but we're going to have some leverage in there. That's not how a self-directed IRA works. So you have to just say, okay, it's completely different and don't think that way. So when an IRA takes on leverage, it's not like borrowing 90%. It's coming in with 90% and borrowing 10. It's flipped where the loan to value ratio is concerned. It's not a Fannie Freddie, FHA, VA kind of a loan. It is a non-recourse loan. So it's not a consumer loan, it's a commercial loan. So it's called a non-recourse loan. And by the way, if anybody listening would like a list of non-recourse lenders, we do offer that list. It's not that we recommend them, it's just for your information. So you can call them and ask them questions, right? So, info@udirectira.com will shoot you that list. But you can so the number one misconception is that your IRA will be the down payment, like a 10% down payment, and then you can borrow the rest. And you don't do that for a multitude of reasons, including the fact that when your IRA earns income because of leverage, the amount that it earned is taxable. And it's a special kind of tax. And I know you know this, but it's called UDFI, Unrelated Debt Financed Income Tax. And it's expensive. So you want to take on as little leverage as possible. So your IRA is not a down payment on a regular house. So you have to figure it out differently. You can call us. We'll talk to you about it. We'll give you the list. You can call the lenders and you can talk to them about what it's going to look like. But pretty much those lenders are going to underwrite because they're looking at how does that property cash flow, right? And that's going to be their return on their investment. That's going to be their security for the loan. But being non-recourse, right? So security for the loan, they can't come after you personally. And they can't come against any of the other assets in your IRA account, just the subject property.
Oh, interesting. Yeah. So basically you don't have the luxury of utilizing, well, I mean, one of the reasons why people get involved and love real estate investing, right, is because of the leverage aspect, right? It's like,
yes,
you can go out and you can put down anywhere between 10 and 25%, let's say, depending on what you're buying and, what it's being used for. And, you use that aspect of leverage, which I guess you technically may be able to do within, your self-directed IRA account, but then now you've got this taxable nature of that you have to deal with if you generate any income off of it. So I guess that's just something to consider. And then of course, it's because it's an IRA account, it's protected, and so they can't basically come after you if you stop making payments. So from a lender point of view, it's higher risk, I guess, right?
Yeah, when I've seen the rates, they're not that much higher than market rates for you and I buying a house, like our primary residence.
Hmm.
It's not that much higher because you're coming in. So yes, in some ways it's more risk, in some ways it's less. If you're coming in with 90% or 70% of the capital for the property and only borrowing less than 50%, well, that reduces the risk as well. So the rates aren't too different.
Yeah, that's a good point. Yeah, because you're not going to be able to utilize, just putting 10 or 20, 25% down. You're coming in much higher than that. So that negates, I guess, a lot of that risk, right?
Yeah, I think in the early days in 2009, we saw a lot of builders building homes and they said, oh, we'll give you a 95% non-recourse loan. Well, that means that 90%, 95% of the income that you receive is going to be subject to this tax, this UDFI tax that's hefty. I mean, it's at the same as the trust rate. So you definitely want to begin with the end in mind, and we can help you along that. Give us a call. We'll give you a free consultation and we'll help you along that path.
Okay, great. And have there been any like recent or maybe even upcoming regulatory changes that affect self-directed IRAs?
I'm really glad you asked that because there have. Pre-COVID in 2019, there was the Secure Act 1.0, and it changed several things about retirement accounts. But I think most notably here, it would be the RMD age, the required minimum distribution age. So it used to be for a very long time that once you hit 70 and a half, you had to take the money out of your account. The year after you turned 70 and a half, you had to start taking RMDs, or required minimum distributions. And with Secure Act 1.0, that age was raised to 72. Well, right at the end of 2022, in fact, I think it was the very last day of the year, the Secure Act 2.0 was signed into law. And what this does is it increases the RMD date, or the RMD age, I should say, from 72 to 73. So now it's 73. It depends upon the year you were born, if you qualify for the 73. But why is this good? Who cares? I mean, this is why you would care, because first off, we live longer and we want our retirement dollars to be, compounding longer, don't we? We don't need them. And if you don't absolutely have to have that money, to live on, why you don't want to pay the tax. So you want to keep earning money, you don't want to pay the tax. So yay, that's great. When you get to that age. Well, here's another thing that Secure Act 2.0 said on this topic, that in 10 years, in 2033, that age is going to 75, which is great. So you won't be required to take the money out in 2033 until you achieve the age of 75 years old. So things are always changing in flux. And what's nice about Secure Act 1 and 2.0 is that it had bipartisan support. There wasn't a lot of, fighting about this. Both sides of the House can see the need for less government dependence upon our retirement. And we really have to take this self-directed, right? We really have to take care of ourselves when it comes to building retirement. And I know that's what your show talks about, different ways to build your wealth so that you have money and you don't have to worry about retirement, right? And this is another way. But I have to tell you one thing though, with Secure Act 2.0, it came out with something new, something like newish. There is a SEP IRA and a simple IRA. The SEP is a simplified employee pension. And then the simple is the Savings Incentive Match Plan for Employers. It's a big old acronym there. So these two accounts, when you contribute to them, they're usually pre-tax dollars. And that means you make a contribution, and then your tax person on your tax return factors in this tax break that you're going to get for contributing pre-tax. What 2.0 said is now the SEP and the simple are going to have Roth-like contributions. So you can contribute Roth-like dollars to these accounts that have higher contribution levels. In fact, the SEP, the maximum cap for a SEP is now $66,000. Imagine putting $66,000 away as Roth, being able to, let that cook, tax-free and come out tax-free until you're 75 plus. That would be nice, right? But here's the thing, they didn't give us any guidance. So even though you've been allowed to do this since January 1st, there's no guidance, there's no like prototype. There's the Department of Treasury has come out with nothing. So we're hoping this summer, maybe the fall, we'll know exactly what the rules are for these, Roth type of contributions to these existing account types.
Because there's been no guidance that's been issued, does it kind of mean that you're kind of a little bit in uncharted waters? Let's say, like, if you were to kind of like utilize these accounts in the way that now they're now being allowed, is that?
You wouldn't want to make a Roth contribution until you know. And with the SEP account, you can make your contribution. For example, now we're looking at the 2022 tax year, and we're all filing that. It's about our tax. There's always a tax deadline coming up. But what was I going to say? So what you really want to do with the SEP IRA, you don't have to actually pay your tax, and you can continue to contribute up until your tax filing deadline. So you can contribute up until the day you actually file your taxes, including extensions.
Oh,
So
wow.
you'll know. So I think that's accurate. Always talk to your CPA. We don't give tax advice. So this is, and you always want to have a good CPA when you're investing, because one of the great things about investing isn't just making money, it's keeping what you earn. And so you always need a good CPA on your team, and you want to keep them informed.
Yes, definitely. I mean, everyone should really check with their tax advisor or consultant, to make sure that whatever their situation is, that that's been vetted, and that it conforms to whatever they're being told. And right now we're just providing loose constructs and ideas that people can go and have a more detailed discussion with their advisor with, correct?
Exactly right. Exactly right. But self-directed IRAs are just so popular, and the popularity is just escalating. And this has been a record year for us. Every month is like a record month after record month. And I think people are enjoying the idea of getting out of Wall Street and into tangible assets.
Yeah, and I'd love to hear that, because essentially that's, one of the major themes of this show, right? Is that, for people to become empowered and to make their own decisions instead of relying on Wall Street and,
Right.
their packaged products, to invest, and for people to basically go out and basically make their own decisions, find their own investments, invest with other people they know, right? That's why I like, a lot of private investments have grown as well too over the years, because people are now deciding that, hey, like I can get better returns, I can invest in something that I know more about. I don't like the 60-40 model of stocks and bonds, and that's proven to work out very well, right? And so there's all these things out there that people can look at and evaluate, and the self-directed IRA account is one way that they can do that, essentially, and grow their wealth.
Yeah, that's so true. And we see that happen every day, people who have invested, and then and then it grows and grows. And then sometimes people will pass away, and they'll put that wealth, and that wealth goes to the next generation, to the beneficiaries. And it's really cool to see how that wealth continues to grow.
Yeah, and these types of accounts, can they be held like in a trust as well too?
Well, you know what? An IRA kind of is a trust. You can have like a living trust that is a beneficiary of your IRA, but an IRA is like a trust in the sense that if you die and you have named beneficiaries, then those named beneficiaries will receive your IRA in the pro rata, the percentage that they get. Like you might be a 50-50 beneficiary, or codependent, or what is that word? Something like that. Anyway, so you get the money, and it doesn't go through probate. It goes directly to that beneficiary.
Okay, great. It's good to know.
Mhm.
Any other things that you'd like to mention with regards to self-directed IRAs?
Just always be thinking about contributing, and put that as part of your budget, because contributing to an IRA is one way to grow it. It's definitely a way to start saving for your future, because the very few of us uh, are prepared for retirement, especially living longer. So factor contributing to your accounts into your overall, financial plan every year.
Oh, well said. Well said. Know what the limits are and make sure you're maximizing them, right?
Yeah, and those limits are on our website.
Okay, great. And Kaaren, how can people find out more about you and uDirect?
Right. So our website is the letter U, uDirectIRA.com. We're on social media all over the place. And we hold events, typically in California, networking events where we bring people and deals together and have a good time. I know I've seen you and your wife at several of them, so it's always good to see you. And so you can find us, you can find us on social media primarily, but our website just really goes deep on the self-directed IRA, or just give us a call. We'll talk to you.
Okay, great. And then we'll include links to the website and also to
Okay.
your social media handles as well too within the show notes
Okay.
as well. Thank you, Kaaren, for coming on to the show today.
Yeah. Thank you. I really appreciate it.
Yeah, thank you. You provided many amazing amount of value to the audience. And that's all for today. And thank you everyone for tuning in. And until next time, have a great week.
Thank you for tuning in to this week's show. If you are interested in learning how alternative investments can help you build purpose-driven wealth, sign up on the High Rise Capital website to receive our monthly newsletter and free investor ebook. Lastly, if you enjoyed this episode, don't forget to subscribe and leave a 5-star review. Thank you for listening to Purpose Driven Wealth, the podcast for empowered investors.